Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia Derivative Berhad in collaboration with the broker partner RHB. So this is the fourth familiarization sessions for Derivative Virtual Trading Challenge, short form DVTC. So this webinar is titled Synthesizing the Street Smart and Book Smart Strategies in Derivatives Trading. So today we are very honored to have invited two renowned speakers to talk about how do we synthesize the street smart wisdom as a bookmark strategies into trading futures. All right. So the session will be split to content presentation by two speakers before we is followed by a Q&A sessions. So the first speaker will be Dr. Ahmad Danial Zainudin, who is an academician from APU, followed by the second speaker, Mr. Eric Lim, who is a manager of business development strategies from RHB Investment Bank. So my name is Shane Chu. I'm the moderator for this session. Now, before we begin, disclaimer, whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed derivative that we mentioned here. If you decide to make any investment or trading decisions, you are solely responsible for all your investment risk. Now, allow me to briefly introduce our first speaker. He's none other than Dr. Ahmad Danial Zainudin. So Dr. Ahmad Danial Zainudin is a derivative market expert and a certified financial technician by the U.S. International Federation of Technical Analysts, IFTA. So he started his financial career at Affin Investment Bank in foreign currency derivative hedging. So he gained further expertise in the derivative market at Philip Futures and Maybank Investment Bank before attaining his doctorate in 2021. So his last tenure in the industry as an associate director in equity derivative at CMB Investment Bank complemented his vast experience in the mechanics of financial derivatives, where he was responsible for overseeing the issuance of the structured warrants before transitioning to academia. So his noteworthy recognition and awards include the Staff Academic Awards by Maybank, Top Futures Broker Representative by Bursa Malaysia Derivative, and the Best Paper Award at the 7th International Seminar on Entrepreneurship and Business. So he currently serves as the academician at the School of Accounting and Finance, Asia Pacific University of Technology and Innovation. All right, so from APU. So today we are very honored to have you here, Dr. Ahmad. How are you today?
Hi Shane. Yeah, very good tonight.
All right, cool. So we can't wait to learn from you how do we synthesize the street smart and the book smart strategy in derivative trading. So I will just stop sharing my screen and hand over the control to you, Doctor.
Sure. Thank you, Shane, for the very kind introduction. Good evening, everyone. My name is Dr. Daniel. I believe Shane already introduced a little bit about my biography to you. Nothing to brag of, but then tonight I'm going to share with you what are the things that you need to consider when you want to start your derivative virtual trading challenge, which will not, of course, suffice everything that you need to know everything that you need to know about the trading, but then at least all the important points before you start trading. Tonight I will share it to you. So before we talk further about synthesizing the street smart and book smart strategies in derivative trading, I believe that the important things about derivative markets you already understand. And at this point, me, Shane, and my other panelists here, Eric, okay, we believe that you already understand that when you want to join this kind of challenge, this kind of competition, you understand that you are the speculators. I believe that you already at least have a very basic knowledge about the financial markets, and you already know what are the types of financial derivative. Of course, we have a few. The first one, we have a futures contract. We also have options. We have warrant. We have structured warrant. We have swap. And for this derivative virtual trading challenge, I believe you are focusing on the futures contract, if I'm not mistaken. And with that being said, actually, I believe, I presume that you already understand you are the speculators, you are not the hedgers. Some of you probably already having your specific or focus financial derivative module or subject in your university. I know that your lecturers already brief you or teach you about the strategies as in like hedging, as in like arbitraging or speculating. So for this challenge, this kind of challenge, you are going to apply the skills of speculation. It sounds not really nice when we talk about the word speculation, but speculation in financial market means you are eyeing for profiteering from any price variation. Because okay, I believe you know that for derivative market we can long, we can short. Long means you are buying the contract, and short is you are selling the contract. At this point, I know and I believe that you're already being informed and you're well aware of those terms and also those important things in futures trading. That one is point number one. I got 9 more points before I'm going to my topic synthesizing the street smart and book smart strategies in derivative trading. Number two, I I must say that you must understand the mechanics of futures contract as a hedging and price discovery mechanism, which I know that you're aware that it opens the opportunity for you to profiteer from the price movement. But again, you are not doing hedging because you don't have any physical asset with you. You're only looking for chances to make money from this derivative virtual trading challenge. Okay, I would like to remind you that the term price discovery mechanism is actually we are using in practice in the real world. We are using the futures price in order for us to know what will be the indicative direction of the spot market or the physical market, and also what will be the reference price, what will be the future price of the physical asset or the spot market in interest in future. So I believe you must understand it by now before you start your challenge in, I think, 2 weeks' time. That one is number two. Number three, you must understand that although in your book, okay, in your book, that's why I am more keen to share with you how to synthesize Street Smart and Book Smart. I believe that in your book, you already read about the spot price, the physical price, and the derivative prices. They are always moving in tandem. They're always positively correlated with each other in a positively correlation magnitude. But the thing is, because spot market and futures market, they are traded by different participants. So when we talking about different participant, it means that the sentiment is different. Futures market sentiment will be different from the spot market sentiment. When we talk about FKI or KLCI futures, for instance, the one that trading in the FKI market is probably not the same person, probably not the same group, not the same institution that trading in the stocks for the KLCI components. They probably not the same thing, not the same person, not the same group, not the same participant. So that's why we can say therefore different market sentiment. So that's why sometimes you will see after this the spot price and also the derivative price there will be different in probably few times per day for the trading day, and that's what we call as a basis risk. There sometimes they may converge and they may diverge with each other. That's number three. Number four, that you should remind yourself every futures contract, okay, every futures contract, it has its own contract specification, and you must understand the futures contract specification. In finance, okay, in finance, we treat the futures contract as a tradable asset. Okay, as a tradable asset. It means that we can buy the contract, we can sell the contract. And it brings us back to the definition of futures contract, whereby it's a promise is an agreement between A and B, who is the counterparties of the futures market, to buy or sell something or to buy or sell an asset in future. The definition is very simple and straightforward. They are promising, okay, they are promising with each other to buy or sell an asset, to buy or sell a commodity, to buy or sell something in future, but everything is set today. So what are the everything? Okay, what is the everything? Everything includes the prices must be locked today. Where you want to deliver must be set today. When do you want to deliver must be set today. What is the quality of the things that you are promised must be set today. The quantity must be set today. That is why when you browse through the FCPO contract specification, I believe until now, the place of delivery or uh, the delivery location, there are only three locations, which are the first one is Butterworth, the second one is Port Klang, and the third one is Pasir Gudang in Johor. So that's what includes in the FCPO contract specification. From the moment I joined the industry about 11, 12 years ago until now, that is the contract specification of Bursa by Bursa, and I believe that um, they, they are keen to maintain it that way. Okay, so it means that you have to know from cover to cover what is the contract specification of each the futures contract you want to trade. That one is number 4. Number 5, I should say that you must be aware when we say about contract, it must have expiry date. It must have a validity period. It should have an expiry dates. And you must know if FCPO is every 15th of the month. Every 15th of the month. For KLCI futures or FKI, I would use FKI and FCPO a lot in my sharing for convenience. So for FKI, it will be the last business day of the month. So you must be aware when would be the last trading day of the contract. But for the case of FCPO, you must know that there will be the first notice day. Okay, the first notice day, which is the day where the seller would send some reminder or notes to the buyer that they are going to deliver. Why? Because when the futures contract, when a particular futures contract approaching what? Approaching the expiry dates, the volume and liquidity will be affected. How you will be affected? You will be having difficulties to get in or get out when the volume and liquidity is impacted. Okay, right. That one is number 5. Number 6, you should know that what are the sequential offered trading month contract or contract months of KLCI futures and also FCPO if you're trading both things. Okay, any futures contract, I don't know, after this probably you already master the futures trading. Okay, and you are looking forward to trade the futures contracts in CME, in COMEX, you want to trade gold futures, you want to trade mini gold futures, micro gold, you want to trade Dow Jones, mini Dow, you want to trade Hang Seng, Hashtag, whatsoever. Probably you want to try yourself, it doesn't matter. But the most important thing is you must know what are the offered contract months. It's very important. Okay, it's very important. Because with that the knowledge of sequential contract months, it brings you to the point number 7, whereby you have to know when you want to trade as a speculator, okay, when you want to profiteer from the price movement, what you need is the volume and liquidity. And where you can get that from active month. But not every contract month of the futures contract is an active month. Like for FCPO, the active month is the 3rd month. So let's just say now is July, and I believe now the contract month is probably they are migrating. The volume is migrating from October to November. How you want to determine that? You probably can see on the volume column in your trading platform later. Right? So only trade in the active month. For LCI futures, The active month is spot month. Spot month is current month. There's a little bit different between physical, not physical, commodity futures contract and also uh, stock index futures contract. You must be aware of that. Okay, number 7. And number 8, when you go through your contract specification of a futures contract, you must be aware what is the tick value, what is the tick size and the tick value. Okay, what is the minimum movement of that futures contract? That is most important thing because that is the basic for you to calculate your earnings. Of course, your platform will show you everything, your portfolio, your balance, your profit losses, your realized and unrealized profit loss. Of course, your platform will show you everything. But the thing is, you yourself must know how the platform calculate. I'm not saying that your platform probably wrong, but it sometimes, okay, sometimes I have, when I want to when I want to share my experience, sometimes we see glitches. Okay, we see glitches. Hopefully, throughout the challenge period, everything will be going fine. Okay, but we cannot deny there will be some possibility that there are glitches. So when there are glitches, you must be prepared. As in, like, you must know your realized and unrealized profit loss is actually what it should be. All right. And number 9, you have to ask yourself, what is your risk tolerance? In FPU, basically, I already have it in my own module, which is financial management. My students already know there are 3 types of risk tolerance. There are 3 types of risk attitude for investors. They are risk averse, which is the one that very, they don't like risk at all. They're also risk taker. They like risk. Okay, and number 3 is risk indifferent. Whatever it is, it just appear the same to them. So you must know you have to do your own risk profiling. Okay, for derivative virtual trading challenge, right? Of course, it doesn't involve actual money. Okay, so this is the very good opportunity for you to dig further about your money risk tolerance by yourself. Okay, because you're not using the real money later. Later, when you're using your own money, at least you have some brief knowledge about yourself. Okay, and lastly, why I want to share about this topic today because throughout my experience in the industry and academia, and when I'm writing my own thesis during my PhD times and master times, I believe that to be a trader, you cannot disregard any fundamental analysis, any technical analysis, and money management. All of these 3 skills must be executed together because it's complemented each other. Okay, they're complementing each other actually. You, for me, I'm a strong believer of there is no strategy fits all. Sometimes fundamental analysis works best because of what market is efficient. But sometimes when you are trading futures contract in emerging countries or emerging markets, as in like Malaysia, as in like Hong Kong, as in like Indonesia, we are emerging markets. When emerging market sometimes not efficient. Hopefully by now you know what is efficiency. What is market efficiency? If the market is not efficient, we call them as an anomaly because that reflects whereby the market participants are not rational. So if you want to explore further about the market efficiency, you can browse, you can Google about the EMH efficiency, efficient market hypothesis. The opposite of EMH is behavioral finance studies, and the EMH is actually supported by Eugene F. Fama. There's a founding father. Okay, there's a founding father that introduced and popularized the EMH. And behavioral finance, people always talk about the Dow theory. Okay, so that is 10 things before we start. Before I start my own sharing. Okay,
Yep. I think
now,
you may start to share your screen, doctor.
all right.
We are not looking at your
I'm not
screen.
sharing yet. Thank
Yeah,
you for
no.
thank you
Yes.
for a reminder, Shane. Let's see, let's see. All right, there you go. So hopefully you can see my screen now.
Yes.
Shane, how is it?
Yes, you may. Yeah, we are looking at it right now.
Okay, synthesizing the
But
street
this is
okay.
on the presenter view. Would you want to turn it to be um non-presenter view?
I think I'm okay now. Presenter view, presenter view, presenter view.
We are looking at your presenter view. That means we are looking at two slides at the moment.
Oh, you are looking at the two slides at the moment.
Yeah, so we can
Okay,
see the next slide.
oh, okay, hide the presenter view. How about now?
Now you're not on a full screen mode.
I'm not. Hang on.
All right,
How about
perfect.
now?
Yes.
Perfect. Okay. Sorry, everyone. It's been a while since the last time I used Zoom. Okay. Can I continue, Shane?
Yes, please.
Okay. All right. As I mentioned just now, why do I keen to share with you this topic, synthesizing the street smart and book smart strategies? Um, the ultimate reason is because I'm a strong believer of there is no one strategy that's gonna fit all. Okay, there's no one strategy that fits all. You yourself must exercise your discretion when you should execute your street smart and when you should execute your book smart. Okay, now again, I would like to repeat that you can use whatever that I shared tonight for your derivative virtual trading challenge. But let's just say you want to use my advice, my sharing for your real trading. Please do consider to complement it with your other sources or references. Okay, this is not to solicit any buy or sell any securities later because of wanting my information can be obsolete, can be outdated. You must update your own information. Okay, all right. Today, I'm going to share with you a very brief thing about money management. Okay, money management. Number two, I want to share with you about market efficiency and anomaly. Other than that, I want to share with you some geo-economic events that impacts on the underlying market events on the derivative markets. And lastly, I want to share when should be the preferred time for decision point of using FE and TE in futures trading. For point number four, why I'm keen to share with you about that, whatever the TA or FA that you are using in the stock trading, probably it is less appeal for futures trading. So that's why I'm sharing you what would be the preferred way for you to trade futures. All right, let's start with the street smart. The definition of street smart is the ability. This definition comes from Cambridge Dictionary. This is the ability to manage or succeed in difficult or dangerous situation, especially in big towns or cities. That is a very very general definition. Okay, there's very general definition. But the thing is, in trading, okay, some scholars when they do research, they are of the opinion that they equates the street smart, okay, they equates the street smart in investing as those who use a technical analysis, because sometimes, probably a lot of times, those people on the street, they don't really have the access for fundamental or economic indicators. They don't have access. So the only thing that they have is charts and charts. Because I believe every one of us, we can access Yahoo Finance. That's the very least that you can access. That is why we always refer, and I agree with this Pandini. Okay, technical analysts always being referred as a street smart. But the thing is, you cannot always rely every time with the charts. Okay, now how about book smart? Book smart, as we know, the one that having a lot of academic knowledge learned from books and studying. That is the definition by Oxford Learners Dictionaries. In investment, we usually refer the book smart uh, when we projecting the direction and trajectory of asset price by using fundamental analysis. The fundamental analysis of futures and the fundamental analysis of stocks are different. Stocks, the fundamental analysis, probably the most important one, EBITDA, enterprise value over book ratio, something like that. But for futures, mostly there's for example, the commodity futures contract like FCPO. This is probably the supply and demand numbers, probably the macroeconomic indicators, microeconomic indicators. And right now, I think the very popular report is about macro thematic report. So those are actually fundamental analysis of futures market trading in the futures market. Right, moving on. So you have to know that I believe right now you already know there are two types of derivative. One is OTC. Okay, one is OTC, over the counter. It means that it's a private agreement. The very simple way for you to remember, let's just say later you want to answer any of financial derivative modules. What's the meaning of OTC? It's a private agreement between A and B. Okay, between A and B. Why? Because everything in the exchange is already standardized. Everything in the exchange is already standardized. You have to follow the contract spec. Okay, so the exchange traded derivative instrument, the most popular and I would say mostly traded in the exchange is futures. Okay, it's futures. And I would say there are six main categories of futures contracts, which is stock index, agricultural stock index is as in like our KLCI futures. Okay, if we are talking about the foreign, if we're talking about the foreign stock index, we can say mini Dow, S&P 500, Hang Seng, Hash Share, what else? MSCI. So those are stock index futures contract. Agriculture futures contract. We do have our own gold futures, FGLD. Okay. 10 years back, I always being requested by Bernama to comment about the market direction of FGLD. I think you can still search my name in Google. We also have the very popular one, FCPO. Okay, FCPO. Then in the US, we have our own rival. You must know that CPO has its rival, which is soybean oil. Okay, soybean oil. Soybean oil exists not only in the US, but also in China. In China, they have another exchange to compete with FCPO, which is Dalian Exchange, right? So soybean oil is basically one of the agricultural futures contract. It comes from soybean. In the CME, okay, in the seaboard, Chicago Board of Trade, they have a soybean, they have a soybean oil, they have a soybean meal, and other oilseed futures contract. That is examples of agricultural. Livestock. When we talk about livestock, as in like um, land hogs. Okay, the hogs. You know what was the hogs? HOGS. They also have. I think there is a futures contract for cow. Okay, that is for livestock. But we last time we didn't really have much traders playing livestock because the margin is very high. You have to know this livestock futures contract. traded in the US, they are denominated in US dollars, so they are very expensive. And you must understand what is the mechanics of the price dynamics for this livestock. Then we have energy. Energy, of course, popular, Brent crude oil, WTI, West Texas Intermediate. We also have the natural gas. Okay, those are actually very popular. You have to know there are differences between Brent and also WTI. Okay, you need to Google up what are the differences. That is example for energy. Metals, there are two types of metals. We have precious metals, gold, silver, those are precious metals. We also have non-precious metal, as in like iron ore, as in like platinum. I'm not really sure. Some of the industry, they categorize platinum as a precious. Some of them they categorize as precious and or non-precious. But for me, platinum is precious. So we have a few. Also, aluminum. Okay, aluminum, palladium, the one that the Tony Stark always put in the chest. Okay, palladium. So these are the categories and examples of metal futures contract. Right. Last time means like 2 to 3 years ago. The most popular, not to say the most popular, the most traded metal futures contract is silver futures contract. Why silver? I'm not sure. I'm not sure. I only see the statistics. Probably in Malaysia, everyone talking about gold, but elsewhere in overseas in the US or globally, like people are trading silver. So I'm not sure why. The last one is financial futures. Financial futures in Malaysia, we have our own CLIBOR, KL Interbank Offer Rate. In the US, they have their own treasury yield, treasury bond. So those are financial futures. The one that I highlighted here is actually mostly traded at the best of my knowledge, right? About last week, okay, mostly traded. So futures by nature, okay, when we talk about futures, they should lead the spot. Should lead means they should be the indicative price of the spot or the physical market. Otherwise, they are useless. Why are you having futures, but then it cannot give you some indication, some clues, some hints, what will be the price of this commodity, this asset in future. So in any way, the futures must lead the spot. That's why if you delve further into academic finance, the scholars, the professors for finance, they're always eager to test or to review, is futures still lead the spot? Is futures still being a very good price reference for its spots? So for us, that is a very important thing about futures. Futures should lead the spot. But as I mentioned just now, futures and spot, they are traded by different participants. So sometimes, yes, futures lead the spot. Sometimes the other way around. Sometimes bi-directional. Bi-directional means spot says I lead the futures. Sometimes future says I lead the spot. Because of what? The sentiment is changing. They keep changing. Okay. And last one, according to the International Financial Reporting Standard 9, okay, the futures should correlate, okay, positively correlate with the spot. The spot and futures should have the correlation around in the range of positive 0.8 to 1.0. For what? For effective hedging and price discovery. So lower than this, it is not to say acceptable, but then as a derivative, that derivative is not really useful. That's why in every finance papers, the researchers always mention it's a very, very important for the policymakers, for the exchange, to make sure that the futures contract or derivative, exchange traded derivative should have a very high correlation with the spot so that the hedging will be effective and price discovery will be efficient. Okay. Now, first slide of the SDD checks. According to the Schrager, okay, you must not to raise more than 1% of your money when you are trading. For example, FCPO, in the normal day, they will move in between around 20 to 50 ticks. And let's just say on the day or someday, the MPOB, you have to know the authorities, MPOB, Malaysian Palm Oil Board, or sometimes MPOC, Malaysian Palm Oil Council, okay, they are releasing the numbers, okay, for the supply of the for the crude palm, the palm oil, okay, there will be a fair chance for the price swing. Sometimes in the morning it goes up, okay, you see there's a bullish trend and you're very confident about it. But after market pause, after lunch, you will see the market swings, okay, the market reverse. Because of what? Due to the any related announcement. So if you think that you are novice trader, probably you only I advise you to set away 1%, not more than 1%. Okay. Now I have example here. Any account, if let's just say you have a 50,000 in that account, in that trading account, probably you can risk the most is 500. More than that, not advisable. Okay, not advisable. Next, there are two types. There are two types of money management for traders. Okay, either you choose frequent small stops, or you choose many small gains with occasional large losses. First one is frequent small stops with few big wins. Okay. The other one is small gains with occasional large losses. You cannot have frequent small stops with occasional large losses. It doesn't make sense, and your trading will be useless. It's better for you to stop trading. In actuality, it's better for you to stop trading. Okay, and ask yourself, do I understand the market or not? If you don't understand the market, okay, just find another market that you can understand more. Okay, you can just find or choose a market you can understand. Sometimes people understand FCPO, but they don't understand the KLCI futures, how KLCI move. They don't understand. Sometimes people understand KLCI, but they don't understand FCPO. So it's up to you. I cannot advise you. You must trade FCPO. You must trade KLCI futures. Okay, so how do we actually find any opportunities for small stops with few big wins or small gains with any occasional large losses? Usually the researchers, okay, the one in the research room, okay, there we will do descriptive statistics analysis. So as you like here, my own computation for KLCI futures, after COVID, okay, after COVID, as you know, the financial markets landscape already changing, okay. The bullish news, we find that more influential than bearish news, okay, more influential than bearish news, because the range for the range for the daily change can be up to 7% compared to if any bearish news coming in, the market, the most it can go down is 5%. And the risk is reduced from 1.5 to 0.98. I believe you can recall your knowledge about the standard deviation, which is we're using it in finance, we're using it as the risk matrix. So how about FCPO? FCPO still no change. Okay, it maintains its behavior. Okay, maintains its behavior whereby the bearish news influence more this market. Okay, the sell side may get rare big wins as the price change indicates a maximum of 10% per day. It can reach 10% per day, but the standard deviation move from 1.54 to 0.98. So how do you read standard deviation, by the way? So according to the statistician, okay, is a plus minus. Sometimes or 2/3 of the time you can get 11.54, okay, and you can get you can minus 10% with the 1.54 for the minimum of the day. That is how you interpret the standard deviation. You have to know finance is not about numbers. Okay, it's all about how you interpret the numbers. The numbers is numbers. Okay, the numbers is numbers. But without interpretation, without a proper interpretation, the numbers going nowhere, and you are going nowhere. Right? Now, next, what's next? Stop trading for the day when it is time. Last time I saw a lot of cases whereby the investors or the traders, they always do revenge trading. Revenge trading means they already lost in one round. Then after that, they enter for another round, still losing, and they're psychologically disturbed. Okay, they are keen not for profit now. Okay, you see the objective already changing. That is the big no-no for futures trading, because you have to know futures is a leverage product. Leverage product means when you see the movement, every movement in the futures market, every movement in the futures, futures market, basically, let's just say FCP or every 1 ringgit movement, it doesn't really represent 1 ringgit. 1 ringgit movement equals to 25 ringgit in your portfolio balance. If it goes up 2 ringgit, it means that 50 ringgit gone. Okay, 50 ringgit gone. Or 50 ringgit add up to your portfolio. So you must be very careful, not only in futures, not only derivative, but in any leverage products. Do not trade with psychological disturbance. That is a big no-no. So you have to know there are 3 stops that a trader you need to consider. First, the equity stop. The equity stop, let's just say you don't want to use my 1% preference or advice. Now you want to use 2%. Once your loss already reached 2% for that day, stop, you go doing something else. That is the best I can advise you. Okay. First equity stop. Okay, first equity stop. Let's just say you already allocate 2%. Okay, you already allocate 2% of the day and it reaches 2%. You already lost 2% for the day. Get out. Get out from the market. Do not leave your position overnight, because we don't know how good is, I tell you what, doesn't matter how good is your technical analysis or how good is the advice that you get from any chartists, any researchers in the world. We don't know what's going to happen tomorrow. Okay, not to say tomorrow, if you lose in the morning, okay, first session, remember market can swing in the afternoon, after the lunch hour, after the in the second session. So that is equity stop. Short stop. Short stop is based on your price action strategy. When it reaches on certain level, okay, be disciplined, stop. Okay, be disciplined. You have to stop. As in, like, if you're using Bollinger Band, okay, if you're using Bollinger Band, you know Bollinger Band, it has a middle line, it has upper line, it has a lower line. Let's just say you are shorting the FKLI. Okay, you are shorting the FKLI. But the thing is, instead of going down, the market goes up. So your borderline, when the price reaches the, when the price reaches the upper line, you think you will stop. So it is, when it reaches, you must stop. Don't think that, never mind, it will go down, it will go down. That is a strategy that at least preferable, the strategy of hope. And I would say that many in my times during when I was in the market, strategy of hope is the least, how to say, um, the least workable in trading. You have to know what you are doing. If you want to stay, you have to justify why. You have to convince yourself why you want to stay in the market. If you want to stay, if you want to stay, if you want to get out, you have to justify to yourself. You have to convince why I want to get out, right? It doesn't matter. Let's just say you are shorting, the market goes up, but you already get out in the second session, the market really goes down. Doesn't matter, because nobody knows what the market going to go in the afternoon. So just accept that we cannot perfectly predict everything. If there is any way to predict everything perfectly, I would like you to share with me. Okay, I would like you to share with me. All right, that is a chart stop. Volatility stop. There is a tolerance. If market is too volatile, you cannot handle, your heartbeat becomes more and more and more than usual. Stop for the day. Okay, stop for the day. So that is what I always advise my clients last time, because I don't want my clients to die due to heart attack. Okay, and it's not worth for you to, to, when you see the market is very volatile, and I believe that you are carrying this challenge while you're going to class, while study. I don't want you to lose your focus in your class. Okay, I don't want you to lose focus in your class. It's better for you to stop. Better for you to stop if the market goes well. Okay, if the market is not to say stable, but then it behaves how it should normally, then go on. Okay, just go on. All right. Next. This is a big no-no, because in stock trading, this strategy is very, very popular. Averaging down with the hope that market will go your way. Okay, market will go your way. That's a big no-no, because of what? In futures, remember, any leverage product, you should never averaging down your losing trade. If your trades are winning trades, you are earning, you have the profits, unrealized profit, doesn't matter, then you can average up, but never ever average down. Never ever to increase position size if you are losing, right? Um, okay. Again, never revenge. Okay, never revenge. If you think that you are busy that day, if you think that you are fighting with your girlfriend, boyfriend, whatever your personal problem is, okay, don't trade, please. Don't trade. For what? To avoid emotionally driven trades. If the market goes away, your trade goes your way, it's just luck. Okay, it's just luck. If it's the other way around, just remember, I warned you. Okay, I already reminded you about never revenge. Okay, I'm done with my SDD checks. The next one is I want to share about derivative market efficiency and anomaly. Okay, you have to know there are three stages. Okay, there are three stages of market efficiency. By now, if you're a bachelor student, okay, if you're a bachelor student, if you're interested with financial market, you have to know there are three stages. And if you are a statistics student, I believe you are very familiar with the first moment, and second moment order. All right. First moment is the mean. Second moment is the variance. And we are interpreting it. We are borrowing, okay, the knowledge, the statistics knowledge to make sense, to make the financial sense of the market. Now, the very first stage is information arrival. So when information arrive, when the first thing first, when the information arrive into the knowledge of the investor, of the trader, they will react. Of course, they will react. How they react? Okay, how they react? Probably they will close their position, or they will add up their position. Okay, it's up to them. It depends on what type of news or what type of sentiment they are having. That is information arrival, the first stage. And after they react, okay, after they react, we have a second stage. We call it as a first moment. It can be, okay, let's just say information for FCPO already reacting, and the FCO traders already respond and already reacting to the news. Now, when the US market opened, the soybean oil traders, for example, they will they will mirroring, okay, they will react to the same news that the FCPO traders already responds. That's what we call market relationship. Okay. And last time, the very popular question the traders asked me, okay, which following which means that in the case of crude palm oil futures and KLCI futures, who is actually leading who? Are we following the US or the US following us? Okay. And they think that because we are the emerging country and US is developed country, of course, in any way, and certainly Malaysia following the US. But the thing is, after we do the analysis, okay, we are analyzing it using the causality test. It turns out that FCPO leading the soybean oil. It means that the traders in the US, okay, whoever trading the soybean oil, they are referring to what happened to the FCPO throughout the day. Okay, that is what happened. If you think that it doesn't make sense, you try to do your own causality test. See if the data changes and the interpretation also changes. And in the second stage, in this first moment, we're also concerned about the impulse response. Impulse response means that, let's just say the FCPO news comes in today, and the FCPO traders respond today. But the soybean oil traders in the US only reacting to the news probably on Thursday or on Friday. So there's a little bit delay. Why? I'm not sure. Okay, I'm not sure. But there is some kind of occurrence like that. This is what we call impulse response. Okay, that is the first moment. How about second moment? Second moment, no news, nothing, no fundamentals, no announcement, but the price move. The price move without without any announcement, without anything, without any clear reason, we call them fluctuation. But if the fluctuation is agile, we call them volatility. Okay, and there are 5 types of volatility. Normal volatility, volatility persistence. Persistence means throughout the day, market is volatile, don't know why. And that's where you can see the clients or the traders asking the brokers or the dealers, what happened, what happened? But then the traders, I don't know, no news so far. And sometimes the client always asking around, anyone knows what happened to KLCI futures, something like that. So there's a volatility persistent. Volatility clustering. Okay, let's just say this morning the market already in the volatility state, but it comes down. It comes down after 10 o'clock, 10:30 o'clock. But after lunch, without nothing, no announcement, nothing, volatility comes again. Why? No one knows why. Okay, no one knows why. Long memory where the volatility extended to probably more than 5 trading days, more than 10 trading days. 10 trading days equals to 2 weeks. You have to know about that. Okay, you have to know about that. So for generalization, okay, 1 month we have 20 trading days. Okay, usually 20 trading days or 22 trading days. Half-life and decays. For those of you that coming from physics or science stream last time, probably you already learned about the half-life in physics. Half-life and decays in finance, we refer to the volatility that's extended to very long time. Okay, the behavior, the state of volatility, it's like very long time without nothing comes out, nothing comes down also. Okay, and it needs a very long time for us to see the volatility dies, volatility gone. So that is half-life and decays. As a trader, you have to know the stages of first moment and second moment. Sometimes market move, but why? Don't know. No one knows why, right? So the news, it can affect the spot market, okay, or it can affect another futures market first. If we talk about the KLCI futures, our own benchmark, our own bellwether, okay, it can affect the Hang Seng first or the Nikkei in Japan. Okay, whatever happened in the US, it might not be directly affecting us, but then it affect the Nikkei first. It might be affecting the Hang Seng first. Only after that it affect us. So that is this category. Other category, the news, the impact of the news, it impacted the spot market first, which is the FBM KLCI. They only when the futures traders see KLCI already tech cues already responding, then futures traders responded into the futures position. And after that only you will see the futures market fluctuates. So there is indirect, there is direct. You have to know where the futures contract gets its impact from, either from the its own underlying market, or the other markets, other futures markets. Sometimes KLCI futures, it gets the it gets the impact from the market that you never think got relation. Okay, probably the gold market. What is the gold market relationship? Export gold with FCPO anyway. In any logical reason, we probably struggling to find why. Okay, but the thing is, it has relationship, but in a way that we're not sure. Okay, probably because financial co-integration, whereby market and financial markets are co-integrated with each other. Okay, but at least by now you already know indirect and direct impact. Right. Volatility, persistent, clustering, and long memory. Okay, as you can see here, okay, for crude palm oil futures, okay, post or after COVID-19 happened, and for KLCI futures after COVID-19, we can conclude that markets are more cautious. Okay, the traders are more cautious, and they always very focus on the information arrival. If the markets become volatile, it can be up to 1 month or 2 months compared to the 1 month compared to 2 months during COVID-19. Before COVID-19, the market is rather stable. Okay, stable means everyone knows what is the actual or normal behavior of the market. But after COVID, 1 month. Okay, after COVID, 1 month. Next, I already surpassed 15 minutes now, Shane. Sorry. I think I should speed up. Shane, is it okay?
Yes. Yes,
Uh,
please.
I think I should speed up. All right. Yeah, thank you. All right. Here, when we talk about the relative market efficiency, okay, for LCI futures and crude palm oil futures, it becomes more efficient. It means that it supported the previous slide, whereby when people becomes more cautious, the market become more efficient. Efficient in terms of what? Efficient in terms of how they absorb, how they respond to the information comes to them. Okay, the volatility persistent, we can say that the lower these values are, it means that the volatility persistent, it recover fast. No longer, it means that the less persist. Okay, and the decay rates before and after COVID, you can see significantly lower. Okay, significantly lower. For those of you probably you are learning about econometrics, you're probably familiar about the autocorrelation. Autocorrelation whereby we are looking for how much the price today, okay, how much the price today, the price of FCPO today or FKL today correlate with their own previous history. So like FKLI here, we can say the price today, okay, let's just say this is today and this is yesterday, this is 2 days before, 3 days before, 4 days before, and 5 days before. It correlates the 2 day before and 3 day before. Okay, why is negatively correlate with the price, the yesterday's price? Because whatever happened yesterday, people already square off the positions. So that's why today market goes up, tomorrow probably market goes down. The same like FCPO after and before COVID. Okay, today market goes up, tomorrow probably market goes down because people are or traders, they are pocketing their earnings. But then it will continue the trend. Whatever the trend on the second day, on the 2 day, the 2 previous day or 3 previous day. It is very important for you to know the autocorrelation, okay, because you need to plot your charts later. Right. Now, next. So here, okay, here you can see that at a glance, okay, this is the correlation between KLCI and mini Dow. This is correlation between KLCI and gold futures, KLCI and an FCPO, KLCI and crude oil, West Texas Intermediate. The idea here is, unlike your conventional belief, correlation is not static. Okay, it is not static. It's always changing over time. Like mini Dow, the most is a positive 0.25. Like FKI and gold, the most is around positive 1.5. I don't know why. Sometimes it can go as lower as negative 0.15. For FCPO, not really correlation, just quite neutral. Okay, KLCI and crude oil can be, most of the time positively correlated. What else do we have here? For mini Dow and FCPO, not really correlated, but I can see here mostly on the negative side, negative correlated. As this is FCPO WTI, around positive 0.05 to negative 0.05 means it's changing. It's okay, it's changing. So what we can draw our conclusion here, the CPO, it recovers early from shocks that come from KLCI or mini Dow, from the stock indices. Okay, from stock indices. If you want to do this by yourself, you can explore econometric model, Gash model, right? For those of you already taking econometric classes. Right, next. Okay, now we compare from the angle of time frequency correlation. So for KLCI mini Dow, for example, okay, for short term, 1 to 2 days, 2 to 4 days, 4 to 6 days, they are not really correlated. But then if you see in the long term, they are pretty much positively and highly correlated. The same with KLCN WTI, they are having very low correlation for 2 months, but after then spiked up to positive 0.6. The same way KLCI and FCPO futures, early of times, probably below than 2 months, they are not really, they are positively correlated, but then after that, they becomes negatively correlated. Okay, they become negatively correlated. Probably people knows that the information no longer relevant, so they just go their own ways. KLCI and gold, for early days, for short term, they are positively correlated, and the most they can go is for long term, positively 0.35. Sometimes people say stock index goes up, the precious metal goes down. Okay, inversely correlated, but this is the proof that it doesn't necessarily go that way. It doesn't necessarily go that way. Sometimes even the old timer in the trading also, they're wondering, I thought gold and stock index, they are inversely correlated. Not every time. Not every time. Okay, the general, yes, but we can only say theory because not every time. Right, mini Dow, FCPO, most of the time, uh, around they don't have correlation at all, but for long term can go to negative 0.5. For CPO WTI, unpredictable. I would say unpredictable. So our findings, okay, our conclusion, intermarkets correlation, they are not constant, they are not fixed, they're always changing. Short term and long term, they're always changing. Okay. So some days the futures market probably a very good candidate for investment or position diversification. Some other days you can, if they are in they are in a positively correlated manner, you can add up your position. All right. I really like this research from this researcher. He says that invested ration is heterogeneous. Okay, whatever happened yesterday, probably today, the traders might not be reacting the same way. It depends on the magnitude of the news. It depends on the importance of the news, and it depends on the relevancy of the news. It depends on everything. It can be the geoeconomic events. It can be the news and announcement from its own underlying markets. It can be from the interrelated underlying and futures markets. It can be in non-interrelated, as what we covered just now. What's the relationship between gold and FCPO? It doesn't seem any relationship, but then market move. Okay, market move. So non-interrelated underlying and futures markets. Also regional. Regional means if you are in Malaysia, our regional markets are China, Hong Kong, Taiwan, Thailand, Indonesia, Singapore, Philippines. Those are our regional markets. So make sure you take notes about this. Right. Determinants of FKLI or KLCI futures price. When there is announcement of Bank Negara Malaysia about interest rate, about OPR, focus. Okay, I advise you to focus. Exchange rate movement, yes, it affect. Other than that, dividend yields of the, the components, okay, the components of the stock index. You have to know what are the constituents of the KLCI. You have to know what are the movements of commodity prices. And yes, we have Monday blues, okay, Monday blues, whereby there is a highest volatility there. And also the month end, during month end. Why? Because people are, or traders are migrating from the expiring month to another next month to the next month. Okay, that one is for LCI futures. How about the FCPO? FCPO again, interest rate movement, industrial production index, Malaysian IPI, exchange rate again, GDP, gross domestic product, our inflation rate, and if anything about trade war, CPO price will react. Okay, it will react. The volatility will be seen as a response of these determinants. Talking about which these determinants for CPO, around September, you will see most probably a spike of the price because of in India, there will be more demand from them. Why? As you know, the Diwali will be around soon, somewhere around October. Okay, in September, they are having another, I believe, pre-Diwali. They call them is a Dasera. It's a festival before the Diwali. So they are going to have festival and they need to cook, they need food, so they are going to need more oil, cooking oil. So you will see most probably the FCO prices will go up. So what does it mean to you? It means that the long-term trend probably bullish, but you have to check again and again and again. You have to check again because the market is changing every day. So what is the decision point? Okay, what is the decision point? FA, FA, as I mentioned, is very important. Okay, in order for you to find the market sentiment, you have to know what is the long-term direction of the market first. But FA cannot tell you where is the exit and entry. So that's why we need to use the technical analysis to time your entry and exit. So the common practice among traders is for futures, we are using 4-hour chart. Why 4 hour? Because it represents the trading session. If you notice, for KLCI futures, we start at 9 and we end at 12:30. Then after that, we resume again at the afternoon. So more or less 4 hours. So in your charts, use a 4-hour chart. Okay. So every day, find the news. Most probably, you can find your direction there. And my preference last time, Reuters. Okay, Reuters, Thomson Reuters. And after you determine your daily trend, verify it with the lagging indicators such as regression lines or MAs. You can find it in the trading views. Okay, then you need to project the day trend with leading indicators such as use of stochastic. Stochastic helped me a lot last time. Seriously, helped me a lot. And lastly, try to familiarize yourself with the parabolic stop and reverse indicator. Most of the time it helps. Okay, most of the time it helps. I come to the last slide of my session today. Okay, this is actually the daily. What you are seeing right now is the daily chart. Okay, the daily chart. Now I want to show you how many opportunities that you can have in one day. Okay, how many opportunities? That's a lot, right? That's a lot. And most of the time, the candlestick, actually, I'm using a Heikin Ashi. I prefer Heikin Ashi because if you notice, the difference between Heikin Ashi and the normal candlestick, Heikin Ashi, there is no gaps. Okay, let's just say market spike, market gaps, Heikin Ashi will cover that. Why is the difference? Because the equation, the formula between Heikin Ashi and candlestick, different. Okay, different. So based on the Heikin-Ashi, you can see there is a very clear trends. There's a lot of opportunity there for you to make money here. right? And it's always in the boundaries, upper line and lower line. And the lesson is there's always time for you to, to make your trades. If let's just say you have a class in the morning, try try to do trades probably around 11 or before the market close. All right, I believe that will be all. Okay, Shane,
Thank you so
I uh,
much, Doctor.
I
All
pass
right.
the floor back to you. Okay.
Yes, thank you so much, Doctor. So, without further ado, I think we will just hand over to Eric, who is a manager of business development and strategy from RHB Investment Bank, to tell us a little bit about RHB's offering in terms of futures and how can retail investors like us participate in derivative virtual challenge trading challenge 2024. So, over to you, Eric.
Eric, sorry, already taking so much of your time.
No worries, Dr. Daniel. Thank
Sorry.
you for the
Okay.
very informative session, and also thank you, Shane, for the very lovely introduction. Um, all right. Okay. Without further ado, let's get this started. Good evening, everyone. I'm Eric, and today I'll be speaking a bit about some of the products, services, and campaigns offered by RHB. After that, we'll go through some details to get you ready for Bursa's Derivatives Virtual Trading Challenge, aka DVTC. So to start things off, as you can see from here, apologies. As you can see from here, RHB Investment Bank has 33 branches scattered across Malaysia with about 500 licensed dealer representatives to service your futures trading needs. Also, we have a dedicated 24 hours global trading support team to assist you in your trading journey. And recently, actually, we have won a few industry awards, and I'm happy to share with everyone that we have won the Most Influential Broker Award in Southeast Asia by CME Group, and also the coveted Best Retail Derivatives Trading Participant Award by Bursa Malaysia for 7 consecutive years since the year 2017. And I would like to take this opportunity to thank all our respective clients and partners for the continuous support. So in RHB, we offer futures products from 6 established exchanges across the globe. As you can see from the screen, these are the suite of products from Bursa Malaysia. We also offer products from Hong Kong Exchange, Singapore Exchange, Tokyo Commodity Exchange, Intercontinental Exchange, and the last being CME Group. So altogether, we offer a total of 74 types of futures contracts that will be available at your fingertips. And over at RHB, we offer 3 futures trading platforms that are suited for all your trading needs. The first being ASGTS, which is the most basic one, but sufficient enough for most of our trading needs. Apart from that, we have QST for the most sophisticated traders. And lastly, we have CQG, which is recommended for the semi-pro or professional traders. We have trading platforms that supports desktop applications and also a web browser, respectively, as you can see from the screen. But all 3 of these trading platforms are available on mobile apps for everyone's convenience. Also, I'm happy to share that we have a live presentation every morning at 8 a.m. Come join us on Morning Kappa, and our team will provide news and coverage on Malaysia's economy, stock picks, and analysis on futures contracts, especially every Wednesday morning. To participate, just join our RHB Retail Equities Morning Kappa at 8 page on Facebook, and the session will be live streamed there. Apart from that, we also have a Telegram page called RHB Investment Bank Official, where we will post daily updates on several futures contracts. You may scan the QR code here on the screen to access the Telegram page. And also from our Telegram channel, you can find out more about our upcoming webinars, campaigns, and events. I'm happy to share that we have 3 ongoing campaigns for everyone now. And what's great is that you can participate in all 3 at once. You may scan the QR code on the next few slides if you'd like to know more about the campaigns, or check out the campaigns on www.rhbtradesmart.com. For this campaign, which is also known as the Trade with Passion Futures campaign, just open your futures account by the 31st of August, and you can enjoy up to 500 ringgit worth of brokerage within the first 60 days of your account opening. Concurrently, we have our latest campaign, which is the Products of the Week Futures campaign that will run until the end of September. Tune into Morning Kappa at 8 every Wednesday, or in fact, tomorrow morning, where we will select two futures contracts. Trade these selected contracts and stand a chance to win weekly prizes and also participate in a lucky draw once the campaign has concluded. Lastly, we have a mega campaign known as a Triple Win and Drive campaign that lasts until the end of the year. Trade with us and stand a chance to walk away with awesome prizes, but 3 lucky clients will do better than just walk. These 3 clients will be able to drive home in a brand new Perodua Ativa. Okay, that will be all for the bank's marketing session. Let's go through some of the details to get you all sorted out for the exciting Derivatives Virtual Trading Challenge by Bursa Malaysia. So this will be the 4th year that DVTC will be held, and the challenge will run for a 1-month period from the 1st till the 30th of August. There's a higher prize pool this year with more interesting prizes worth a total of 87,000 ringgit as compared to 40,000 ringgit last year. To register, head over to www.bursamarketplace.com or just Google DVTC 2024 and fill in your particulars before the end of the registration period on the 25th of July. Once you have registered, please make sure that you receive a confirmation email that looks like this, and you are able to access your DTS account with the web version here, and also download the mobile application from these links. Also, from now all the way until the 25th of July, you'll be able to access the platform already. That is also used for the challenge. This is so that you can familiarize with it, or in fact try out some of your trading strategies. So how the challenge works is that you will start off with 100,000 ringgit worth of virtual capital on the 1st of August, and the objective is to trade your way to achieve the highest account balance at the end of the challenge. To be eligible for this challenge, all you have to do is trade at least 20 lots of futures products, whereby if you buy 1 lot and sell 1 lot, it will be considered as 2 lots traded. Do remember to check out the TNC for more information on this challenge. The 5 products selected for this year that will be available for this challenge are crude palm oil futures, gold futures, the FTSE Bursa Malaysia KLCI futures, the FTSE for Good Bursa Malaysia Index futures, and Bursa's very first currency futures, also known as the Mini USD CNH futures contract. So what's great about this about the DVTC challenge is this challenge will be beneficial for everyone, from beginners all the way to experienced traders, because not only you will be able to experience real-time trading, but you can get a feel of the market as well. It is important to understand the contract specifications for the available products before you start trading, as mentioned by Dr. Daniel earlier, and as you will be trading based off the actual contract specifications at the actual trading hours for each of these products. The experience from this is great because these are all based off real-life scenarios and market conditions, which will be useful in your trading journey. Also, the challenge is a good opportunity to test out any trading strategies that you have been itching to try. So while the challenge is based off virtual capital accumulated at the end of it, the rewards from this campaign are very real. The top 20 participants with the highest account balance will walk away with prizes, as you can see here from the screen. The top 3 participants will be able to win a whopping 10,000 ringgit in cash, followed by 7,000 ringgit and 5,000 ringgit, and so on. On top of cash prizes this year, you will be able to stand a chance to win digital gold from the Bursa Gold Dinar app, and also a seat in an advanced futures trading workshop conducted by a professional trader. Personally, the price for the advanced futures trading workshop is the one that caught my eye, because how often are we able to get the opportunity to be able to seek guidance and advice from a professional trader? There is a saying, give a man a fish and you feed him for a day. Teach him how to fish and you feed him for a lifetime. I'm not saying that everyone can make trading a full-time job, but if I would learn, I would seek it from someone who does it for a living. And this slide is just to show you how the Bursa Gold Dinar app looks like. If you're interested, do check it out from your mobile app store. So this will be the last my last slide. This is our list of webinars planned for the third quarter of this year, and we offer sessions conducted in English, Bahasa Malaysia, and Mandarin as well. We have many more webinars and workshops lined up until the end of the year, so please look out for the updates, and we hope to see you there. So that's all from me today. Thank you for your time, and if you have any inquiries, do reach out to us via email at rhbib.futures.bdev@rhbgroup.com or via phone call at 03-9280-8820. Thank you, and I'll now pass the floor back to Shane.
All right, thank you so much, Eric. So if you have any questions to ask any of our speakers today, you may write your questions at the Q&A box, not the chat box. Write them at the Q&A box, and we will address your questions accordingly. We have 8 minutes left to do these Q&A sessions. So please feel free to ask any of the speaker any questions that you may have in regards to futures trading. Then we'll do our best to address your questions. The first question I see on my screen is that usually when it comes to gap up or gap down, 1% risk, 1% is usually the gap is already more than 1%. So how do we strictly follow this rule? Maybe Dr. Ahmad, you are able to address this question.
Okay, all right. Thank you, Shane. The thing is, not every day. Probably we can see, you have to know there is, the exchange already set some kind of limit, probably limit up or limit down. When it reaches that limit, they will just like that, they will execute a circuit breaker. Probably they'll just post the market. So what I'm sharing to you, okay, tonight is basically the normal and average behavior of the futures market. Okay, last time during the early days of COVID, okay, I think in the US market, they already reached limit down. Okay, limit down or limit up, I can't really remember. And that is extraordinary event. Okay, that is extraordinary event. So not every day we can see the market will go up by 1%. Not every day we can see the market will go down by 1%. If you're talking 1% gap up or gap down of KLCI futures, it means that you're talking about 16 or 20 points movement per day. That is a lot. Okay, that is a lot if you're talking about 1%. So of course we cannot strictly follow the rule, but then we must have a guide. At least we must have a guide. Okay, hopefully, Chia, that helps you, right?
All right, so the guide is 1%. Huh? I think you can also don't hold your positions overnight, okay, or over any break,
Shane,
so that
agree
you
with
don't
that.
subject to the gap.
I agree with that. Preferably your position, especially when you are holding losing position. It's a big no-no, because I can see that most of the positions, they are already making money for 3 straight days. On the 4th day, the market swap everything. So whatever that you get that day, just take it home. Okay, just take it home. Just realize it, right?
All right. So the next question is, how do you manage emotions in trading? Maybe Dr. Ahmad?
Siyong, I'm not a psychologist, I'm not a psychologist, I'm not a certified psychiatrist, but one thing that I always, not one thing, two things that I always advise my former clients last time. First thing first, you don't fall in love. Okay, don't fall in love with any markets. Okay, first, let's just say you, I don't know, probably not now, probably, oh, now, let's just say you are trading KLCI futures and CPO simultaneously, but one of them, okay, one of them losing. Yeah, you're having a losing position in one of them. Let's just say you are losing in a KLCI futures. So it shows that you don't understand KLCI futures. When you don't understand KLCI futures, but again, you want to trade KLCI futures, the thing is you are losing. So what I can say, just leave the KLCI futures because it shows that you only understand how to trade a CPO market and stick to CPO market, stick to commodity if you can understand that better than equity markets. That one is the first. That one is the first one. I always tell my client. Second one is revenge trading is a big no-no. I think I already covered that in my slide just now. If you are, let's just say in the early of morning, okay, you start your day with trading, then instead of making money, you are losing. And I will say, if you don't believe me, you try. I will say after you lose your money, you square off your position, you offset your position, you cut your position, and you try another position. If your trade, you're earning, your next trade is earning, it's luck. Okay, because it's no longer your next trade is no longer based on your focus, which is to earn money. It's just merely revenge. I want to cover what I have lost just now. So the psychology already changed, already deviate there. So I cannot personally I cannot give you an exact tips how to manage emotion. If you think that you are not up for it, okay, stop trading for that session. If you think that you're ready for the next session, continue. It's your call. It's not my call, it's not Eric's call, Shan's call, it's your call. Okay, Siam?
All right. Thanks, Doctor. The next question is by Mr. Bahaudin. So, Doctor, are there any good books to recommend to help us in futures trading?
Ayo. Talking about good books, basically what I'm sharing to you tonight is summarizing of good books. Good books. If you want to read books, I think you're gonna be wasting your 1 month trading challenge just reading the book. You can always reach for your assign. I believe they will be being assigned the brokers later, right, Shane?
Well, I think they can indicate whether they already have an account with any of the 4 participating broker. Yeah, when they sign up for DVTC. Yeah.
The best thing for you, let's just say you are referring to this trading challenge, okay? You can ask around. You can ask around the brokers that are gonna be assigned to you or whoever that is more experienced in the market than you. That one is the first one. Second one, okay, I always tell my students, okay, and my clients, if you want to Google up anything about investment or finance, only dependable on Investopedia or Corporate Finance Institute. For me, these two sources are trustworthy, okay, trustworthy, rather than you wasting your time reading the whole hundreds pages of the book, okay?
All right. Thanks, Doctor, for the tip. All right. Maybe Eric, let's end this session with the last question for you, right? So do you have any tips for the investors today to ace the DVTC 2024?
Investors today. Okay. Personally, I think for those who are aiming to win, sticks to don't use too many indicators. Because once you use too many indicators, it will create a lot of noise, and sometimes it may not give you the correct call. Whereas for those who are just starting out, I think that if you go in with the intention to learn, it is a great platform to try out any strategies. And yeah, just try it out, test out a strategy, and if it works, in fact, you may actually apply it in the everyday trade. So yeah, apart from that, I wish everyone good luck. Do your research and enjoy the challenge.
Yes, thank you so much, Eric. So, last shout out is that this Derivative Virtual Trading Challenge 2024 is only open for 1 month for you to trade and win this challenge. So there's no participating fee. In fact, you will be, aided by the broker to help you to win this challenge. So you can use the QST platform for free. And it is only for this DVTC. All right. So if you are ready to enroll into this virtual trading challenge without risking your hard-earned money to trade the futures market virtually, you may go to a DVTC website, which is you can go to Bursa Malaysia website to find out DVTC, and then you may sign an account and indicate whether you have any account with any of the brokers here. All right. So you can easily find that out. All right. So with that, I hope to see all of you here at DVTC 2024. So thank you so much to Dr. Ahmad and also Eric for sharing with us about futures trading as well as Derivative Virtual Trading Challenge 2024. Thank you so much, both gentlemen.
You're welcome.
All right. Bye-bye, everybody.